Hi there, my name is Simon Michevich and we're going to be talking about inheritance tax planning and the gifts that you might make of your property, whether that's your home or a buy-to-let property, and the risks associated with that gift. There's been a lot of people asking me about the risks, so here is a video for you guys. Before we get into the detail, there are three channels that I'd like you to know about. The first one is Expat International Tax, if in case you are leaving the UK, go to other countries, or indeed leaving the US. We've got the UK property tax, you're watching that right now. And then finally, we've got moving to Spain as well. There are the QR codes there, but there are the URLs also in the description box below. So inheritance tax, let's think about this. There's the IHT-free allowance, which is £325,000 for a person. And if you're a married couple, then you also get that doubled to £650,000. That is net asset value. So we're looking at gross asset of the property, let's say in question, less the debt. And if it's £325,000 after you remove debts out of the way, then that's going to be IHT free. So don't look at the £500,000 gross asset value and think, oh gosh, that's going to be subject to IHT. No, it's not. You remove the mortgage and then whatever the net balance is, that will be subject to IHT. Now you do have an extra allowance of residential nil rate band, which is £175,000 for a single person, and again doubled up to £350,000. That is tailored away once you got assets above £2 million. So make sure you get some tax advice if you've got assets above that to work out, well, how do we get that residential nil rate back? Total asset value for an individual, you can have net asset values of £500,000. I do need to emphasize again the word net, and £1 million for a couple. Any excess over those bands, you are going to be subject to 40% inheritance tax, which is phenomenally high. We do know that the governments can change, and these will probably be changing at some point. Inheritance tax on gifts. So again, something that people think is that I make the gift and it's immediately free from IHT. That is not true. You will have to live for a minimum of 3 years, because if you don't, then it's going to be subject to 40% tax. So still the banded rate that we talked about. If you live for 3 to 4 years, then that is reduced from 40% to 32%. 4 to 5 years, it's then going to be 24%. 5 to 6 years, 16%. 67 is 8 years, 8%, and then eventually 7 beyond that is going to be IHT free. So you do need to live for 7 plus years in order for that gift to be no longer part of your estate. So we're talking about gifts with reservations. One other problem that I do see people do, and it's another risk, is that they make the gift, but let's say it's a home. Then they keep in the home. They don't pay anything towards it. Well, that's a gift with reservation. You've not really given that property away. You've still got the asset. All you've done is change the title, the legal title, to say, wait, it belongs to my son or my daughter or whoever. But actually the benefit is still yours, and therefore it's considered a gift with reservation. It means that for IHT purposes, HMRC will look through everything from a legal documentation perspective and say, no, we know what you did. That's still a benefit to you. You have to now pay inheritance tax, so be careful with that one. So what you need to do is gift the house with no comeback. So it's not the case of I've got a criteria document to say, well, this house is yours, but if you do this, this, and this, or I do this, this, and this, it comes back to me. That's not going to work for you. You have to say this property is now yours and it will never be mine again. Okay, so that's the first thing. Next step is to pay market rent and actually pay it. One thing I do see a lot of is people looking for loopholes or ways to escape. And the problem is with that approach is that it will always bite you. And with inheritance tax, you're not around to justify what you have done. In fact, people probably don't know what you've done. So you're going to leave your family exposed. So you have to look at market rent of the home that you're living in, that you've now gifted away to your children or other people. And you need to pay market rent. How do you know it's market rent? Go to a local letting agent to establish those facts. you then need to pay it. There's no point just saying, I had a book and here it is, every month I've got in the book that I paid this money. But then they check your bank account and you say, well, you've not actually physically transferred any money, you've just noted it in a book. That doesn't count. You physically need to pay the cash to the person now that owns the property. You, in effect, become a tenant. And again, you have to live for 7 years, because if you don't, it still comes back to you as part of your estate, and then you have a discounted inheritance tax liability, but you still have an IHT bill to pay on that property. Okay, so the risks: lose control and kicked out. Now, this seems quite extreme, but I have seen reports now in places like London, Manchester, Birmingham. It's all over the UK where this happens. And we're talking about parents that have given up property to their children, and there's been a falling out, and the children have kicked out the parents because they may be on a tenancy agreement, or they're not even had a tenancy agreement in place. There's a level of trust, but that trust is quickly eroded away, especially when kids get married, right? There are going to be disputes, and then therefore, I've seen so many news reports that the parents have been evicted from what is technically their own home. That's a big risk. So you do need to be mindful of that approach. The other side to this is something called Tony Turek. This is a story that was told to me a long time ago by a good friend of mine, Gary Hans, who works for a financial services company, AMG Wealth. And one thing he talks to me about is making gifts to your daughter or your son, and they've got a spouse, and that spouse can't be trusted. The problem is with making a gift to your children is if they are cohabiting, not even married, and they fall out, and now you gifted the property to them, the person, Tony Turag in this instance, that is the boyfriend or the girlfriend, if you like, of your child, never mind married, can now take ownership of 50% or even more of that gifted property. So in the first instance, you've been kicked out. The second instance is that you made a gift, and maybe 6, 12, 18 months down the line, your children have fallen out with that person, and then they've taken 50%. It's now 50% or even more out of your family. And maybe that's not something that you want to do. And again, this is all about tax planning. Making gifts to children is very good, but what about the risks? And these two risks are significant. Now, you can put controls around all these things. So you could say, actually, I'm going to put this into a discretionary trust, in possession trust. I have the rights to stay in this property, to pay you rent. So it stops that issue of you being kicked out. And the second part is, if it's in discretionary trust and your children fall out with their spouses, then they can't take that property. So it's a level of protectionism. So I can talk to you about a tax plan, but you need a legal protection plan as well. And that is where a family lawyer will help you. And need to pay capital gains tax. One of the big things that people aren't aware of is that gifting a home is CGT free. But if you're giving away a buy-to-let property, then you have a capital gains tax liability instead. And that can be quite a surprise to people when they make those gifts. And then HMRC come knocking with a letter to say, we believe you sold a property and you've not paid capital gains tax. Here's a 30% penalty. That can be quite substantial. So again, you do need to get some tax advice whenever you're making gifts to children and for inheritance tax purposes, to protect yourself from a tax blunder or a legal issue down the line.